Let me tell you something that almost no one in financial media is saying clearly enough, and I want to be direct about this because I think the vagueness is costing people real money. The petrodollar is not just weakening. It is in the final stage of a structural unraveling that has been building for over a decade, and the reason almost no one is ready for what comes next is not because the information is hidden. It is because the mechanism underneath the headlines is being explained incorrectly, and when you misdiagnose the mechanism, you misposition your capital, sometimes catastrophically. I have spent my entire career studying how large debt cycles and monetary systems behave across history, not just American history, but going back through the Dutch Empire, the British Empire, every major reserve currency transition the modern world has seen. And what I can tell you with confidence is that we are sitting inside one of those transitions right now, not approaching one, inside one. The question is not whether this is happening. The data is unambiguous to anyone who looks at it honestly. The question is whether you understand it well enough to be on the right side of the wealth transfer it will produce. Because every monetary transition in history has produced a wealth transfer, not a collapse, not an apocalypse, a transfer, from those who hold the assets that lose value through the transition to those who hold the assets that gain it. That is what I want to walk you through today in precise terms. The first thing I need to correct is the framing that dominates most of the commentary you will find on this subject. When people discuss the petrodollar's decline, they talk about BRICS nations, about China settling oil trades in yuan, about Saudi Arabia diversifying away from dollar-denominated contracts, about India buying Russian crude outside the dollar system. And those things are real. I am not dismissing them. But they are symptoms. They are what the unraveling looks like from the outside. They are not the cause of the unraveling. And this distinction matters enormously for investors, because if you believe the petrodollar is dying because of external pressure from China and Russia and the BRICS coalition, then your conclusion is that this is a geopolitical contest that could theoretically be reversed, that American diplomatic or military pressure could slow or stop the process. But if you understand that the petrodollar is dissolving because the internal logic that created it and sustained it for 50 years no longer holds, then you understand that no amount of geopolitical maneuvering can reverse the direction. You can only navigate it intelligently. So let me take you back to 1974 and explain exactly what was built, why it worked, and why the internal logic has now broken down. The year is 1971. Richard Nixon is in the White House. The United States is running the first significant trade deficits in its modern history. The cost of the Vietnam War and the Great Society domestic programs have pushed government spending far beyond what tax revenues can support. Foreign governments, particularly France under de Gaulle, have begun demanding gold in exchange for the dollars they are holding. Because under the Bretton Woods system that was established after World War II, every dollar was technically convertible to gold at $35 per ounce. The United States did not have enough gold to honor those conversions at scale. So Nixon did what governments throughout history have done when the math stops working. He changed the rules. On August 15, 1971, he announced that the United States would no longer convert dollars to gold. Bretton Woods was over. The dollar was now a purely fiat currency, backed by nothing except the faith and credit of the United States government. And immediately, a very serious problem presented itself. If the dollar is backed by nothing, why would the entire world continue to hold it as their reserve currency? What gives it its value? What creates the structural demand for dollars that allows the United States to run deficits, to borrow cheaply, to spend beyond its means without triggering the kind of currency collapse that would ordinarily follow? The answer to that question was constructed over the following 3 years, and it was arguably the most consequential financial arrangement of the 20th century. In 1974, Secretary of State Henry Kissinger and Treasury Secretary William Simon traveled to Saudi Arabia and negotiated what has come to be known as the Petrodollar Agreement. The terms were elegant in their simplicity and devastating in their long-term implications. Saudi Arabia would price all of its oil exports exclusively in US dollars. Every nation on earth that wanted to buy Saudi oil, which meant every industrial economy, every developing economy, every country that needed energy to run factories and transportation systems and power grids, would first need to acquire US dollars, and the Saudis, accumulating enormous dollar surpluses from oil revenues, would recycle those surplus dollars back into US Treasury bonds. The other major Gulf producers, Kuwait, the UAE, Abu Dhabi, followed suit. In exchange for this arrangement, the United States provided military protection, security guarantees, intelligence sharing, and a geopolitical umbrella over the Gulf region. American naval power in the Persian Gulf and the broader Middle East was the enforcement mechanism for the agreement. The Saudis got security. The Americans got something far more valuable than security. They got the ability to print the world's reserve currency with the knowledge that structural global demand for that currency would always exist because every country on earth needed oil, and oil was priced in dollars. What this created was what economists call an exorbitant privilege, a phrase first used by French Finance Minister Valéry Giscard d'Estaing in the 1960s when he was complaining about American power, and it is exactly right as a description. The United States could run persistent trade deficits, import far more than it exported, and not face the currency depreciation that any other country would face in the same situation, because the rest of the world needed to hold dollars regardless. The United States could borrow at lower interest rates than any other country because the petrodollar recycling mechanism meant sovereign wealth funds and central banks were permanent structural buyers of U.S. Treasury bonds regardless of the yield. American consumers could buy cheap imported goods for decades because the dollar stayed artificially strong. American corporations could access global capital at lower cost than competitors from any other nation. The entire architecture of American financial prosperity from 1974 through approximately 2015 was built on this foundation. And here is what I want you to understand about foundations. You rarely notice how much weight they are carrying until they begin to shift. The shift began quietly and for a reason that almost no mainstream financial commentator connects to the petrodollar story clearly enough. In 2008, the United States began the shale revolution. Through a combination of horizontal drilling technology and hydraulic fracturing, American energy companies began unlocking vast reserves of oil and natural gas that had been technically unrecoverable under previous technology. The production numbers over the following decade are staggering. U.S. production went from approximately 5 million barrels per day in 2008 to over 13 million barrels per day by 2023. The United States surpassed Saudi Arabia as the world's largest oil producer. Then it surpassed Russia. Then it became a net energy exporter for the first time since the 1950s. And this single fact, this arithmetic reality of American domestic energy production, is the internal cause of the petrodollar's dissolution, because the entire 1974 bargain was premised on the United States needing Saudi Arabia, needing Gulf stability, needing to ensure the free flow of oil through the Strait of Hormuz, because American industry and American consumers depended on that oil. When the United States became the world's largest oil and gas producer, the strategic calculus of that need changed fundamentally. The country that once shaped its entire foreign policy around Middle Eastern energy security now produces more energy than it consumes. The enforcement incentive, the reason America was willing to station carrier groups in the Persian Gulf and spend trillions maintaining a military presence in a region 12,000 miles from home, has structurally weakened, not disappeared, weakened. And in geopolitical systems, as in financial systems, when the enforcement incentive weakens, The arrangement it was built to maintain begins to loosen, slowly at first, then with gathering speed. You are watching this play out in real time right now if you know what to look for. The strategic repositioning of American military posture away from the Middle East and toward the Indo-Pacific. The tolerance for regional instability in the Gulf that would have been unthinkable 20 years ago. The declining urgency in Washington around protecting the Hormuz corridor. These are not strategic mistakes or signs of weakness or confusion. They are a system in transition behaving exactly as systems in transition behave. The anchor has shifted. The behavior that follows from the anchor is shifting with it. And when the anchor of petrodollar recycling weakens, the downstream consequences for financial markets are profound, structural, and very specific. Let me walk through them precisely because this is where the practical importance for your savings and retirement accounts becomes direct. For 50 years, the petrodollar recycling mechanism was the largest structural source of demand for U.S. Treasury bonds. Gulf sovereign wealth funds, oil exporting nation central banks, and the dollar reserves of every importing country in the world needed a place to park their dollars, and U.S. Treasuries were the most efficient, most liquid, most creditworthy instrument available. This structural demand kept Treasury yields lower than they would otherwise have been, probably by somewhere between 1 and 2 percentage points over extended periods, according to various academic analyses. Think carefully about what that means in practical terms. Every mortgage rate in America over the last 50 years was lower because of petrodollar recycling. Every corporate borrowing cost was lower. The federal government's ability to run deficits without triggering a debt crisis was underwritten in significant part by this structural foreign demand for its bonds. The entire financial architecture of American life, the affordability of homes, the accessibility of credit, the stability of pension funds holding fixed income, was quietly subsidized by an arrangement made in a Riyadh meeting room in 1974. Now that structural demand is contracting. Foreign holdings of U.S. Treasuries as a share of total outstanding debt have been declining measurably. The trend is not dramatic in any single quarter, but it is consistent and it is directional. And when the structural buyer base for a $36 trillion debt market contracts, something has to give. What gives is yield. Yields have to rise to attract the marginal buyers who remain the domestic investors, the pension funds, the money market instruments, the buyers who will purchase treasuries, but only if the return is attractive enough. Higher yields on $36 trillion of outstanding federal debt mean higher annual interest payments. The Congressional Budget Office projects that within this decade, annual interest payments on the federal debt will exceed the entire U.S. defense budget. That is not a recession forecast or a political opinion. That is arithmetic applied to publicly available numbers. For investors holding significant fixed income in their retirement accounts, and a very large number of people in their 50s and 60s hold substantial bond allocations, often without fully appreciating how much. This is the central structural risk of the next decade. I want to be precise about the distinction between what I call cyclical risk and structural risk, because understanding this distinction is worth thousands of dollars to anyone who takes it seriously. Cyclical interest rate risk is what we experienced in 2022 and 2023 when the Federal Reserve raised rates aggressively to fight inflation. Bond prices fell sharply, but cyclical risks resolve. The Fed eventually cuts rates, the cycle turns, prices recover. Many investors who held through that period did not face permanent impairment. Structural interest rate risk is categorically different. It occurs not because of a policy cycle, but because the underlying demand base for the asset has permanently shrunk. When the buyers who were structurally required to purchase your asset regardless of price, because they needed to hold dollars and treasuries, were the only efficient place to park them, when those buyers reduce their participation permanently, the yield adjustment is not temporary. It is a repricing to a new equilibrium. You cannot wait it out the way you wait out a Fed cycle. The new equilibrium is simply a world where bonds yield more than they did in the petrodollar era, which means they are worth less than they were, which means a bond-heavy retirement portfolio carries more risk and lower expected return than the models built on 50 years of petrodollar suppressed yields would suggest. This is not my opinion about where rates will be next quarter. This is the logical consequence of a structural change in who buys the asset. Now I want to move to what I consider the genuinely underappreciated dimension of this story, the one that most investors, even sophisticated ones who understand the Treasury dynamics I just described, have not fully integrated into their thinking. The United States is executing what I believe is the most consequential geographic reorientation of its economic and strategic posture in generations. The direction of that reorientation is inward and southward, toward the Western Hemisphere, toward resource relationships and supply chains that do not depend on maritime corridors running through contested waters on the other side of the planet. You can see this playing out in the sustained pressure on Venezuela, in the quiet opening of investment conversations around Venezuelan heavy crude, in the strategic interest in Guyana's offshore oil discoveries, in the reshoring of manufacturing supply chains from Asia to Mexico and the broader Latin American region. But the most important and least discussed dimension of this Western Hemisphere pivot involves a category of resources that are not oil, not gas, but the physical inputs to the technologies that will determine which nations lead the global economy for the next half century. The economy that is being built right now, the artificial intelligence economy, the electrification economy, the advanced defense technology economy, runs on a specific set of critical minerals. Cobalt is the cathode material in the lithium-ion batteries that power electric vehicles and grid storage systems. Nickel is essential for EV drivetrains and the stainless steel applications that underpin modern industrial infrastructure. Copper is the foundational conductor in every data center, every EV charging network, every solar panel installation, every wind turbine, every piece of electrical infrastructure that the energy transition requires. Rare earth elements, particularly neodymium and dysprosium, are the materials from which the permanent magnets in electric motors and advanced weapon systems are made. Without these minerals, you cannot build the technology economy of the next 50 years. Period. The demand for these materials over the coming decade is not speculative. It is the physical requirement of commitments that have already been made. Electric vehicle mandates in Europe, the United States, and China. Data center build-outs to support AI workloads that are growing exponentially. Defense procurement programs that increasingly depend on electronics and precision guidance systems built from rare earth materials. The demand side of this equation is essentially locked in. The supply side is where the opportunity and the geopolitical contest are located. China understood this earlier and more clearly than anyone else. Over the past 20 years, Beijing has systematically built control over critical mineral supply chains through a strategy that is patient, well-funded, and largely invisible to Western investors because it does not happen on stock exchanges. China currently controls approximately 60% of global rare earth processing capacity, meaning even minerals mined in other countries frequently have to be processed through Chinese facilities before they can be used in manufacturing. China has secured dominant cobalt supply through investments in the Democratic Republic of Congo, where roughly 70% of global cobalt production is located. It has pursued nickel in Indonesia and the Philippines. It has built battery manufacturing capacity on a scale that Western competitors are only beginning to respond to. The competition for critical mineral supply chains is the defining resource contest of this decade, not oil, which the United States now produces in abundance, but the physical inputs to the technologies that will shape economic output and military capability for the next 50 years. And this contest is the lens through which I believe a very specific and largely overlooked geographic asset needs to be understood. 90 miles from the coast of Florida, there is a country that holds cobalt reserves that rank among the largest in the Western Hemisphere. A country that sits on significant nickel deposits, meaningful copper resources, and rare earth mineralization that has not been developed to anything approaching its productive capacity. That country is Cuba. I understand that for most American investors, Cuba does not register as a serious financial consideration. It has been off the table for so long, more than 60 years of embargo and economic isolation, that it does not appear in portfolio discussions or investment frameworks. That absence from the conversation is precisely what makes it worth discussing carefully now, because the pattern of history is consistent on this point. The most significant investment opportunities do not announce themselves at the moment of obvious resolution. They are recognized by patient capital in the period before the obvious moment, during the phase when the strategic logic is clear, but the political pathway is still uncertain. Eastern European infrastructure investment began flowing before the Berlin Wall came down, not after. Vietnamese manufacturing investment accelerated before full diplomatic normalization was complete, not after. The investors who captured the significant returns were the ones who understood the structural logic and positioned accordingly, accepting the uncertainty of timing and exchange for the magnitude of the eventual return. The strategic logic around Cuba is not complicated once you remove the political noise. The United States is engaged in a competition with China for control of critical mineral supply chains. Cuba holds significant underdeveloped deposits of exactly the minerals that competition is about. Cuba's historical economic isolation has been sustained in significant part by external support, Venezuelan oil subsidies, Iranian economic relationships, Russian technical assistance. Each of those support structures is under sustained pressure from American foreign policy. The Venezuelan government is facing intensifying economic and political isolation. Iranian finances are constrained by sanctions that show no sign of meaningful relief. Russian capacity to provide external economic support to allies is severely limited by the cost of the war in Ukraine and its own economic pressures. The country that sits 90 miles from Florida, with mineral resources that are strategically vital to the technology competition of the next half century, is more economically isolated today than it has been in decades. Historically, that kind of isolation creates the conditions for the political change that precedes capital access. I am not predicting the specific timing or the specific pathway. What I am saying is that the structural logic, the resource endowment, the geographic proximity, the strategic context of the China competition, and the historical pattern of how these situations resolve all point in a coherent direction. And that direction is toward a moment when American and Allied capital will access those resources, and the investors who have positioned themselves in anticipation of that moment will capture returns that are not available after the moment becomes obvious. Let me now bring all of this together into a practical framework for thinking about your portfolio in this environment, because abstract analysis is only useful if it connects to specific decisions about where your savings are allocated. The transition I have described from a dollar system anchored by petrodollar recycling to a system anchored by domestic energy production, Western Hemisphere resource access, and a reconfigured supply chain geography is a transition in where value is stored and where it is created. And it has very specific implications for different categories of assets that I want to be precise about. Long duration dollar denominated fixed income treasury bonds with maturities of 10 years or more, investment grade corporate bonds, any fixed rate instrument with significant duration, faces a structural headwind that is meaningfully different from the cyclical risks that bond investors have navigated successfully for the past several decades. I am not suggesting these instruments will collapse in value overnight or that they have no place in a portfolio. I am saying that their expected returns over the next decade are structurally lower than their historical averages, and their risk profile is higher because the demand base that suppressed yields for 50 years is contracting. In a retirement planning model built on the assumption that 10-year Treasuries will behave as they did from 1990 to 2020, this is a significant miscalibration. The dollar itself will face sustained but gradual pressure. The dollar remains the dominant global reserve currency and will not be displaced quickly. Dollar dominance is deeply embedded in financial infrastructure, contract law, correspondent banking, and the simple network effects of a system that the entire world has built its financial plumbing around for 80 years. But gradual and persistent devaluation against hard assets is the most likely trajectory because the structural source of artificial dollar demand, the petrodollar recycling mechanism, is weakening. What your dollars will buy in real terms in energy, in metals, in food, in services, will continue to decline more than official inflation measures capture. That erosion of real purchasing power is the quiet tax that transitions of this kind impose on savers who remain stationary while the system shifts beneath them. Hard assets are the historical answer to exactly this environment. Gold has functioned as a store of value through every monetary system transition I have studied across history. When the Bretton Woods system ended in 1971 and the dollar was severed from gold convertibility, gold moved from $35 per ounce to over $800 per ounce by 1980, not because of speculation or panic, but because the monetary anchor that had artificially suppressed its price for a quarter century was removed, and the market repriced it to reflect the new monetary reality. The petrodollar system served as a secondary anchor, creating artificial structural demand for dollars that kept hard asset prices lower in real terms than they would otherwise have been. As that anchor loosens, the same dynamic applies, and gold's performance over the past several years, which has significantly outpaced most mainstream financial commentaries' expectations, reflects the early stages of exactly that repricing. Mining equities, particularly those with exposure to the critical minerals I described, cobalt, nickel, copper, rare earths, represent what I believe is an early stage opportunity that resembles in its structure the early stage of the oil sector repricing in the 1970s. The demand trajectory for these materials is not speculative. It is the physical requirement of the electrification and AI infrastructure build-out, the commitments of which are already made and whose physical implementation requires these exact materials. The supply response to that demand takes years of geological surveying, permitting, financing, construction, and ramp-up time. The gap between demand certainty and supply constraint is precisely where patient capital has historically found its most significant returns, and infrastructure exposure to the Western Hemisphere, the companies building the ports, the processing facilities, the energy networks, the manufacturing capacity of a reshoring American supply chain represents a longer horizon opportunity that is less about speculation and more about participation in a structural reorientation of where American economic relationships and American capital deployment are directed. These are positions in a multi-year trend, not trades on a quarterly earnings cycle. Let me close with the observation that I think frames all of this most honestly and most usefully. Every major monetary transition in history has produced a generational wealth transfer. I want to be precise about what I mean by that, because the phrase is often used to evoke fear, and fear is not the appropriate response to what I am describing. When I say wealth transfer, I mean a revaluation of different categories of assets relative to each other. The assets that were artificially supported by the old system lose real value relative to the assets that benefit from the new one. The people who understand which assets are which and who adjust their allocation before the transition is fully priced in, preserve and grow their wealth through the transition. The people who do not adjust, who remain heavily allocated to the assets most exposed to the structural change, experience a real decline in purchasing power that feels gradual until suddenly it does not. When Bretton Woods ended in 1971, the investors who recognized that the dollar's real purchasing power would decline and that gold and hard assets would reprice accordingly built genuinely generational wealth over the following decade, not because they predicted every twist and turn of the path, but because they understood the mechanism and positioned accordingly. When the petrodollar system was constructed in 1974, the investors who understood that it would create durable structural demand for U.S. financial assets and suppress commodity prices for a generation made the corresponding adjustment and rode that trend for 40 years. We are at a comparable inflection point right now. The system that shaped the financial landscape for half a century is in structural transition. The transition will take years, not months, and the path will not be straight. There will be periods of apparent stabilization. There will be moments when the dollar rallies and gold corrects and commentators declare the thesis wrong. That is how every transition of this kind has behaved throughout history. The arc is not determined by the short-term noise. It is determined by the underlying mechanism, and the underlying mechanism here, the weakening of petrodollar demand for U.S. Treasuries, the strategic pivot toward the Western Hemisphere, the critical mineral competition with China, the underdeveloped resource endowments in America's geographic backyard, is as clear as any structural transition I have observed in 5 decades of studying these systems. The investors who are positioned early, who have moved meaningfully out of long-duration fixed income and into hard assets, critical mineral exposure, domestic energy, and Western Hemisphere resource plays, will look back on this period the way serious long-term investors look back on 1971, not as a crisis they endured, as an opportunity they recognized before the obvious moment arrived. The petrodollar era built extraordinary prosperity for those who understood it. Understanding how it ends is not a counsel of despair. It is the beginning of a serious response. If this kind of structural analysis is useful to you, subscribe. I will keep working through these long-term cycles with the same precision and share what I observe as clearly as I can. The transition is already underway. The only question is whether you are positioned for it.